Welcome to another episode of Breakaway from the Rat Race. And today I have the pleasure of speaking with Derek Dombeck. Derek is a successful investor. He has been surfing up and down the market since 2003. Derek's expertise range from creative deal structuring, wholesaling, flipping, the full gamut of investing in real estate investment. He has been involved in thousands of transactions in his career. And what sets him apart is his love of people and trying to make them successful. Derek co-owns a private lending company called Best REI Funding, a real estate acquisition company, and hosts 3 national mastermind groups called REI Circle of Trust. They also run an annual advanced strategies and networking event for real estate investors called Generations of Wealth Voyage. Derek, welcome to the show. Sorry, I didn't know if I had to say some more. How are you doing?
I'm doing great, Eric. Thanks for having me back. It's been a few months, and last time we had a really good conversation about creative deal structuring, if I remember right.
Yeah, that's right. So let's talk a little bit about kind of like that, like the deal structuring. I get a lot of questions. Maybe you can get started right away about kind of like, is this a good time to buy? Like the interest rates are, higher than they used to be. They're lower than they were a few months ago, but they're still higher than they were like in 2021. So what's your feel about the economy? Is it still a good time to invest? And then how do you deal? And then we can talk about kind of like, how do you deal with these higher interest rates? How do you structure your deal differently, maybe to take advantage of some opportunities out there?
Yeah, I think there's always opportunity in any market. And if the more education you have, the more experience you have, we see things differently than somebody that maybe has only bought a handful of properties.
Yeah.
Interest rates don't bother me. I've been looking forward to the increasing interest rates for quite some time in the regard of, turning this into a buyer's market instead of a seller's market. That really bodes well for us if we want to hold property longer term. I've never really been somebody that wanted to buy based on appreciation only. I mean, I want cash flow. The appreciation is the bonus.
Yeah.
And so we touched on it last time I was on your show, buying like properties with creative structures and seller financing and purchasing subject to, and I still believe that those opportunities are only increasing. Mm-hmm. And from the lending side, with our lending company, because we're short-term, hard money, private lenders, since I've been on your show before, we've certainly seen a shift. Our borrowers are starting to have more challenges selling. They're taking longer to get refinanced. We have a very low default rate regardless, but we've had a few more defaults in the last 3-4 months we're working through. And most of them, a couple of them are just borrowers that, they screwed up and now they're just, they're hiding. Yeah. Those are not the ones that we enjoy. We have to turn those over to the attorney, take them back. It is what it is. Yeah. But the other ones are investors that, they really wanted to do the deal. Even when we did the loan 6, 7, 8 months ago, they were probably pushing their offers a little higher than they should have, which we only lend to a certain threshold, but that means they have to bring more cash to the table. Yeah. And we caution all of our borrowers as we're underwriting the loans, don't use comps that are from 6 months ago. I mean, I don't want to use comps that are more than 3 months old at this point. Yeah. Don't range out so far from the subject property. I get people that bring in these CMAs from a realtor and they're pulling comps from 2-3 miles away in a city like Milwaukee. Yeah. Well, Milwaukee, you can go 2 blocks and it's a different neighborhood. Yeah. It could be a very bad neighborhood.
And 3 miles away, you're outside of Milwaukee now.
Right. Or a completely different school district, or of course, there's so many different nuances, right? And that's the shift that I'm seeing, Eric. Wholesalers are starting to starve. A lot of wholesalers built up a very a large overhead in marketing costs, a large overhead in acquisition people. They're starting to lay off, cut back.
Mhm.
And these are all signs of opportunity for those that are looking for it.
Yeah.
Yeah.
That's what I found also. I mean, I have a wholesaling company too, and yeah, things have really slowed down. Obviously we were selling a lot of these properties to institutional investors. Many of them just say we're not buying anymore. And then we're seeing a little bit of individual investors that picked up a little bit, but not enough to replace like institutional investors that were making the bulk of the deals. But so I still think that there are great opportunities out there. I mean, when we're looking at you're talking about kind of like trying to determine the after repair value of the property before buying and stuff like that. Also, because there's less transactions, there's less real estate transactions. What happened is that a neighborhood where you were able to find comps easily within the last 6 months, all of a sudden it's a little bit drier. There's not as many transactions in that particular neighborhood. And then you have to kind of extend your range a little bit in terms of dates and all of that. I try to stay with kind of like within the neighborhood, but maybe extend, instead of 6 months, it's 9 months to find some comps that kind of make sense. What do you think about that?
We have to do that when there's not enough data. We have no choice. But then we kind of put a spreadsheet together comparing what was the interest rate at the time, a 30-year fixed interest rate, when that comp that's 7, 8, 9 months old compared to what it is today. And we try and index that.
Yeah.
So, because most people buy on monthly payment, not necessarily on the price of the house. We know that's just the way Americans are.
Yeah.
So, I mean, if it's sold for $250,000 April 1st and the interest rates were 3.5 and now they're 7, we have to factor that in. It's not going to sell for as much money.
Yeah.
And our borrowers don't want to hear that. When we come back out of underwriting and say, well, this is what I feel it's going to be worth, and we're still going to fund the deal, but you may have to bring another $10,000, $20,000, $30,000 to the closing table if you want to do the deal.
Yeah.
And so, yes, you're right. We do have to use the data that's available and alter it. And that does come with experience.
Yeah. And I think that kind of makes sense to kind of adjust the kind of like the interest rate based on the interest rate that it was like 9 months ago, to kind of like figuring out, like, adjusting the value based on that. I think that kind of that makes sense, because people are buying based on how much they can afford to pay every month. But some of the loans that you're doing for the hard money loans, are you doing that for people that are flipping to retail investors? Or are you doing these loans for people that are flipping to not retail investors? Are you flipping them? Are you lending for investors who are flipping to the retail people, for owner occupied, or for people that are flipping for rentals?
Primarily, there's 2 buckets. The people that are flipping, doing a full-blown rehab, are going to sell to an end user that's going to live in the home.
Yeah.
The other loans are landlords that are going to do still a rehab, but obviously not as high quality of materials. And they're going to get a tenant in there, get it seasoned for 6 months, and refinance it with a long-term bank.
Yeah.
And those people are the ones that we're having more default challenges with, because, again, they bought these properties when interest rates were 3.5, and they didn't project interest rates going to 7 or 8 when it was time for them to refinance. So now they have properties that don't cash flow, which is a rookie mistake.
Yeah.
Because obviously interest rates are never going to stay static for a long period of time. And they can't get 30-year fixed rates. They got to use commercial type loans with balloons. So for those of us that have been in the industry for many cycles and have seen different markets, this is just normal. But people that have started in the last 5 years, that have honestly never seen a challenging time to sell a property, they're freaking out.
Yeah. Yeah, I mean, yeah, we had to change our because we do turnkey flips, like turnkey rental flips. So yeah, I mean, we had to change our criteria around like February of last year, our acquisition criteria, and we were trying to project kind of like when we sell that property. So we're gonna buy this property today. We're gonna do the renovation, blah blah blah. It's gonna take 6 months for us to sell that property. We were trying to project what will be the interest rate at the time for our investors, what kind of loan they're going to get to make sure that it's still cash flowed and it still had a good return. So we're trying to do that and adjust that in advance. And that really kind of like squeezed the number of houses that made the criteria that we acquired at that time.
Yeah, and that's exactly what we have to do as the lender.
Yeah.
Same thing. And we're trying to project something that our borrower does not want to hear.
Mm-hmm.
They just want to live in, unicorn and rainbow land and think everything's going to be perfect all the time. It's just not the reality. We have one right now that he's selling the property and he owes us $38,000 in excess of what the property's selling for.
Oh, wow.
And he thinks that it's okay that we're just going to eat that, and we're not going to eat that. We're not doing a short sale. This is that has to be made up. So there's some challenge, but again, I would say, because we do a lot of our underwriting based on our experience, and because we're still buying and selling, our default rate is still 1%. I mean, the national average for hard money lenders is a 25% default rate. We're at 1%.
Yeah,
that's okay.
Yeah, that's pretty good. Do you see a big so that's on the investor side, people that are doing like rentals and they're doing kind of like BRRRR and try to do refinancing on the other end. Do you see so you seem to it sounds like these investors have a little bit more challenging time than people that are flipping for the end users, for the retail side. So why do you think that is?
I think it's inexperience. I think they're self-employed, so it's harder for them to get loans. Mm-hmm. And I mean, if somebody's flipping to sell to an end buyer, there's a larger pool, right? Like there's 100 buyers that might want that house. This landlord may only have 1 or 2 options to get financed.
Yeah,
maybe 3 options. And if those don't work out, now their only backup plan is to sell the house. And if they did a half-ass rehab because they were just going to put tenants in it, now it's not going to sell for what they thought it would.
Yeah,
it's just all these hopes and dreams, right? Yeah. So that's our job as a lender, is to underwrite and look at all of the possible scenarios of what can go wrong, and we have to educate our borrowers every step of the way.
Yeah. So what are some of I mean, you're a specialist in creative financing strategies, and I would say like acquisition strategies. So what are some of these the strategies that people can use right now that they want to acquire properties, to invest or flip? So can you give us some hints as to what's the best strategy right now?
I really like options. I think they're significantly underused. They certainly can be used in conjunction with a lease, but just using options, for example, going to Florida, hurricane hit, right?
Yeah.
And there's a whole lot of people that have tarped roofs or roofs, depending on what part of the country you're from. I get into this discussion with a friend of mine all the time. But they can't afford to get their roof fixed.
Yeah.
And so it's $20,000, let's say. Yeah. You approach them, knock on their door, offer to pay for the new shingles, which you pay directly to the contractor. But in exchange for that, you now have an option to purchase their house for the next insert number of years that you agree to, right? The next 10 years, the next 20 years, at a purchase price that you agree to right now. And it's a great way to build a future portfolio, especially using like a retirement account. You could have a small IRA that has $20,000 in it.
Yeah.
Look at an option on a property and it doesn't mean that you have to hold that option for 10 years.
Yeah.
And be the one that actually exercises it. You can turn around and sell that option the day after the ink is dry.
Yeah.
Right.
How do you secure that option though? Like you can't can you put a lien on the property or anything like that? If they already have a mortgage, often the first lien position doesn't allow a second lien position. So how would you secure that to make sure that you get at least your money out if
Yes. So most people just record the option on public record. I am not a fan of that.
Yeah.
And I'll explain why. But I want to secure it actually using a mortgage or a deed of trust, depending on your state.
Okay.
Almost nobody does it this way. And one of my good friends is the one that taught me how to do this. The methodology is twofold. First one is, if you only record the option, regardless of the first position, if they want you to or not, I mean, that's really your risk. You are not in first position.
Yeah.
Always get a title search done before you hand over any money to find out exactly what position you're going to be in.
Yeah.
But if I just record the option, options have been missed. It has happened. They go and sell the house to somebody else.
Yeah.
Or they refinance the house and in excess of what your purchase price is, right? And that option could get missed in a title search, and your only recourse is then file a lawsuit.
Yeah.
So let's play this out. If you gave me an option to purchase your house, Eric, and then you decide to sell it to somebody else for more money, and it actually gets closed.
Yeah.
My recourse, I can go against your title insurance. And so there's an insurance claim / lawsuit.
Yeah.
I can take you to court, but in no circumstances am I ever going to be able to get the sale of that property reversed.
Yeah.
Whoever you sold it to is a neutral third party who didn't know, and the judge is never going to say, okay, we're taking it back away from those people, and you have to sell it to Derek.
Yeah.
So I'm going to end up likely getting a money judgment against you.
Mm-hmm.
Well, we all know that having a judgment doesn't mean you get paid.
Yeah, doesn't give you the money.
Right. So whether it got missed or however it actually happened, once that property actually changes, deed transfers, I'm pretty screwed on getting the property. Okay. Now, if I have you agree to and secure the option using a mortgage, that gets recorded instead of the option.
Yeah.
Mortgages almost never get missed, but even if it did, now I can reverse that sale because I have the right to foreclose.
Yeah.
And now you're still going to get sued, but you're going to get sued by the other person you sold it to in this example.
Yeah.
Right. I'm just going to foreclose, take the property away, and they're going to get evicted, and then they're going to come after you. I can still go after title insurance too.
Yeah.
So the mortgage gives me a lot more teeth. The other reason I like the mortgage versus just recording the option, if I just record the option and sue you and we end up in court, we're arguing over contract law. Yeah. And there's gray areas in contract law, and the judge or magistrate can have their opinion as to what the intention was of our contract. They could say, well, I don't think Eric really understood what he was signing, therefore we're going to unwind this. Yeah. If you sign a mortgage collateralizing that option, that's not gray area, it's black and white. Yeah. And it would be really tough for you and a judge to unwind that and the intent of that. Yeah. Right. So to me, it's way more powerful. Yeah. And let's just say you didn't sell to somebody else, but a year or two goes by and you're refusing to honor my option to purchase your property, and you don't want to sell to me. You want to keep living there. Yeah. I have the mortgage. I do have a right to foreclose. Yeah. Yeah. And the other thing too is that the if you have another mortgage, we also prevent them from refinancing, right? Correct. Absolutely. And so this has happened to me where I get a random phone call from a title company or a lender saying, we're just checking what the payoff is on your mortgage.
Yeah.
because they don't know. Typically, I put the dollar amount of my purchase price on the actual recorded mortgage, but that's not the payoff. So
Yeah.
they have to contact us for a payoff.
Yeah.
And that's a new negotiation time, right?
Yeah.
Because, well, what are you doing? Are you trying to sell to somebody else?
Mhm.
I don't think so.
Yeah.
Or you're going to pay me to go away.
Mhm.
Or are you trying to refinance?
Yeah.
Okay. But again, I can't let you refinance in excess of what I'm going to purchase it for.
Yeah.
Right. So it's very powerful.
Mhm.
And I was on a podcast a few months ago that was run by a real estate attorney. And we had this same conversation. She had never heard of doing it this way.
Yeah.
She actually didn't even think it was a great idea until we talked it through
Yeah.
for a while. And so myself with my PhD, my public high school diploma, educated that real estate attorney, you know, but it's just experience.
Yeah. And yeah, exactly. I mean, yeah, it's yeah. So the experience is very, very key. The other thing too that yeah, and I think that the reason why I think a lot of people don't do this is that you kind of think that, well, if they already have a mortgage on it, as soon as you're going to try to put a second mortgage on it, is going to trigger the first one, and then that's going to be, you know, you're gonna call the loan or something like that, right?
Well, it's interesting that you say that because a lot of lenders, every lender, let's just say every lender has a due on sale clause.
Yeah.
In most mortgages, I shouldn't say most, a percentage of mortgages do have language in it that says they do not want any junior liens behind them,
Yeah.
which this option would be a junior lien, and they could call the loan due. The
Mhm.
odds of that, I would say, are extremely slim.
Yeah.
But if they did, okay, once you have a mortgage in place, there's a thing called lender courtesy.
Yeah.
So if I'm willing to foreclose in the second position and make the first position whole, either by paying them out or by continuing to make the payments,
Mhm.
most lenders will allow that. So I could go as just a civilian and ask the lender to allow me to buy the property subject to that loan, and they would say, nope, we're going to call the loan due.
Yeah.
But if I come in as a mortgage holder, as a lender, which is how they're going to view me, and say, I have to foreclose against this property. Will you work with me and allow me to continue making the payments to you? And most of the time they will say yes.
Yeah.
It's the same scenario,
Yeah.
little bit different documentation. That's
Yeah.
all it is.
Okay. So what do you think, so how do, if one is interested in doing something like that or exploring that, what is the best, where do they get that information? Like, where do they know exactly, do they have to get then a real estate lawyer to really help them out and convince them that they've watched this video, then they know that this is how it should be done and all that kind of stuff? How do you do that?
Well, like anything, it's who you know, it's where you get your education from. There's a lot of great stuff on YouTube, but there's a lot of really bad stuff on YouTube. So you just got to beware.
Yeah.
When you're getting something for free, that doesn't necessarily always mean it's the best legal advice. You know, I'm not going to sit here and give legal advice for obvious reasons.
No.
I'm not an
Yeah.
attorney.
Yeah.
But the way I did it is I surrounded myself with people, you know, my mentors, they're friends now, deep, you know, long lasting relationships. And when I came up on a real estate deal that I didn't know how to do, I reached out
Mhm.
and they helped me through it.
Yeah.
Sometimes we partner with people, you
Yeah.
know, that I get people all the time that call me up and they heard me on a podcast
Mhm.
and they're like, hey, I got this deal. Can you help me work through it? Well, I say yes to the degree that it's not going to be 10 hours of my time, you
Yeah.
know. If your listeners had a real estate deal, creative deal, and they didn't know how to do it, could they email me and reach out? Absolutely.
Mhm.
You know, if somebody wants 10, 15 minutes, no problem. Somebody wants
Yeah.
10, 15 hours,
Yeah.
that's now a
Exactly.
partnership or something, right?
Yeah.
It's just the way the real world works. So that's what I did. I educated myself. I'll give you a source, which is where the majority of my mentors' information can be found on one website. There's a ton of content, a lot of coaching call type of stuff, archived seminars. And that's honestly some of the most brilliant people that I know in this entire country as far as the creative deal structuring space.
Okay.
And that website is cashflowdepot.com.
Okay.
So Cashflow Depot is not a free site. It's cheap. I don't know, $20 a month.
Okay.
But in there, you're going to find people like Peter Fortunato, Dykes Bodiford, David Tilney, Bill Cook, Jack Miller, like all these guys who predominantly were in the southeast part of the country
Mm-hmm.
and all came up together, kind of like the Rat Pack of real estate. And I just really latched onto that group of people, and I got to know all of them. And the ironic part is I'm in my, I'll still call it mid-40s. I turned 47 tomorrow, but
Ooh, happy birthday.
most of these guys are in their 70s.
Yeah.
And these are some of my best friends in the world, and so that's how I did it, and that's how I still do it. If I have a question, I reach out to them, and now I see them all the time. We do things together and host events together and stuff, but back then it wasn't that way. So
yeah. So how do you approach? So that's one part of it. So having a team that kind of knows what how to set these things up, how to make sure that you're protected. Obviously, having a real estate lawyer as part of your team would be kind of important also. Especially if you're doing it across multiple states, then you're probably going to have multiple lawyers that are going to be there at least on counsel to help you out with some of these documents. Not necessarily on every single one of them, but at least have
initially
the template and know that you're protected when you're doing them.
Yep.
So that's kind of like one part of it. The other part of it is really kind of like, how do you talk to the people, the actual homeowner, and say, hey, I noticed that your roof is falling off. You don't have the money to do this. Can you come up with a deal? How do you approach them?
So there's two different approaches. If I'm talking to somebody that came to me through marketing, so it's not a cold call. It's more of a warm introduction. I have an elevator pitch or a spiel that I say every time within the first 2 to 3 minutes of the conversation. So Eric, you call me up, you've got some form of distress, or you just want to sell your house. I simply say, Eric, I buy houses in several different ways. All cash is going to be my lowest offer typically. If that doesn't work for you, we can buy houses by taking over your debt payments. If you don't have debt, we could make payments to you over time. In fact, in some cases, we just lease your property and we buy it later. That usually comes into play if we're working with a landlord who's trying to offset some capital gains. I just tell you all this so you understand. I'm going to ask you a lot of questions that may not be normal, and I'm really doing it to see if I can come to a solution for you today.
Yeah.
Is that fair? Okay.
Yeah, that sounds good. Yeah.
So
and actually, it sounds very positive.
Part,
you're more like a problem solver at that point, and you have, you're not cornering yourself into one particular way of acquiring the property.
And the last part of that spiel was, I said, would that be okay? Or is that fair? You just gave me permission to ask you any question.
Yeah.
And if you did get upset further into that conversation, I can always go back and say, listen, Eric, I'm only asking you what your mortgage balance is because I'm trying to figure out a way to help you. Yeah. And it diffuses almost every situation. Yeah. And most of the time it doesn't escalate at all because you've set the precedent, up front. Yeah. And if you truly are trying to help people, they know it. If you're lying to them and you're trying to take advantage of them, they know it. Yeah. So I am coming across because I truly want to help them. Yeah. So that's how I do it when it's warm. If I was knocking on the door and it's cold and I'm just, there's a tarped roof or overgrown grass or whatever the reason is that you're knocking on the door. My good friend Bill Cook, who is actually the owner of Cashflow Depot, he built his entire portfolio door knocking. So anybody that wants to learn how to door knock, just jump on Cashflow Depot, look at Bill Cook's stuff, and you'll be an expert door knocker in 45 minutes. But here's the cliff notes.
Yeah.
You knock on the door, you back away from the door a long ways. I mean, you get 20 feet from that door.
Yeah.
Okay. What that does is people feel comfortable opening the door, stepping out of the door, and now you can start a conversation.
Yeah.
In that conversation, if it wasn't a tarped roof, even if it is, you could literally just say, my name is Derek. I love this neighborhood. I want to buy a house here. Do you know anybody that might be considering selling?
Yeah.
That's it. You're not even talking about their house.
Yeah.
As far as they know.
Yeah.
Or you can simply say, my name is Derek. I love this neighborhood. I notice you have a tarp on your roof. I help people, get their homes repaired if they can't afford it.
Mm-hmm.
Would you be interested in talking?
Yeah.
Simple. And if they say, no, I'm good, my insurance company's taking care of it, they just haven't got to it yet or whatever it is, say, awesome, great to meet you. Do you know anybody else in this neighborhood that I could help?
Yeah.
Ask for a referral.
Yeah.
That's it. That's all you have to do.
Yeah, it's less threatening also. It's like, what do you mean you want to buy my house? No, I don't want to buy my house. Well, but if it opens the door. If they are interested in buying a house, then they can definitely let you know. So that's a very non-threatening way of getting to what you really want.
And it's amazing, Eric. I've gone out door knocking with Bill, and there's been 20 of us, literally 20 of us knocking on doors in a group. And we will all get invited into the house.
No way.
We've been invited in. We've had drinks. I mean, beer, cocktails. I had a pet parrot on my shoulder one time. Bill took us out that one day, and my daughter was 11 or 12 years old at the time. My daughter was making written offers on houses when most adults are scared to death of it.
Yeah.
But it's people are in general, they're kind. It's really true if you approach it right.
Yeah. So lots of options. I heard that also as we're wrapping up here, you're also planning a book. I think a book is going to be your collaborator on a book, and I think it's going to come out in the next couple of weeks. Of course, we're recording this in January. Not sure exactly when that's going to be published, but so sometime in January, February, your book is going to be published that you're collaborating on. Would you mind sharing a little bit more about that book? I think the title, is Next Level Your Life. So tell us a little bit more about that book.
Yeah, the book itself is being published by a guy named Kyle Wilson, and Kyle Wilson was the business partner to Jim Rohn, and of course Jim Rohn has passed away, but Kyle was the man behind Jim Rohn, is the way I would explain it.
Yeah.
So Kyle is really good at bringing excellent people together to collaborate on books. And so there's about 35 authors. We each wrote a chapter in the book.
Yeah.
We've got a Navy SEAL that's in the book. We've got the CEO and chief editor of the LA Tribune is in the book. We've got a couple other well-known real estate investors, just things. So it's everybody's inspirational story, each chapter by chapter.
Okay.
So I'd love to give that away, the electronic version to your audience.
Yeah.
By the time this does come out, the book will be published. It's being published and released January 24th. So it'll be available on Amazon if you want the paper copy, or you can reach out to me direct and I'll sign one and send you one. But if you want just electronic version, simply shoot me an email. My first name, Derek, at bestreifunding.com, and we'll send it to you.
Okay, that sounds good. Thank you very much. Are you accessible on social media as well? Where can people reach out to you beside the email?
Yeah, LinkedIn, Facebook, my full name, Derek Dombeck. I do have a TikTok account, but I don't put a lot of content out there. That's at this point, we're working on that. Instagram, same thing. I'm starting to work on increasing that. I don't really have anything published, but we need to. All of
Yeah.
us need to. It's just the way it is nowadays.
These are good platforms. It's a good way to reach out to people. So I highly recommend you spend a little bit of time on that. TikTok, Instagram, lots of content there. I mean, it was a lot about dancing cats before, but now there's a lot of serious contents.
I get some of my best barbecue recipes off TikTok. I love
Oh, well, I guess I'm following the wrong people.
it. I know what you're following, but we can't talk about that here.
Dancing cats.
Yeah, something like that.
Well, Derek, thank you very much. Thank you for sharing your experience in here, and then especially on the creative financing and acquisition for your next deal. Thank you for opening your door also for people that want to reach out to you, and then maybe spend a little bit of time and pick your brain to help them out. So really appreciate that. And then we're going to look forward to your book when it comes out, and hopefully people are going to reach out to you and get a free copy when that gets published. Derek, so thank you very much.
Thank you for listening to Break Away from the Rat Race with your host, Eric Martel. If you want to share your story and experience with our listeners, please message us on Facebook at Break Away from the Rat Race. Also, please subscribe to our YouTube channel and our podcast on iTunes.